to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
I'm always impressed by the guy that did that. Sounds like shouldn't be me. Anyway, like the guy said, Bullington Capital Report here every Saturday morning, normally from 11 to noon. But the traffic was unbelievable. I counted 7 accidents on my way in. I'm only about 15 miles away. So it's amazing the difference in the roads. Holy cow, about 5 miles into it, they just really got bad. And they weren't bad at all down near Fairlawn, where I came from, which is where my new office is. We're trying to get everything moved in. It's only about a mile away from my existing office, but it's going to be really easy to get to because it's right off of 77. You'll just take it right to Route 18, and we're right around the corner. So really looking forward to that in 2018. A lot of things that we're going to be doing a little bit differently. I think we're improving significantly. I think there are some changes that have come about in the financial services industry that are actually helping people. I know they are. It's not actually. They're helping people without a doubt. And we're going to have a seminar this Thursday to talk about some of those things. If you're aware of the risks that are being created and the opportunities that are being presented, I think you're going to do pretty well. I think you'll be very happy over the next few years. You may not have been happy over the last 4 or 5 years because there's only a small section of stocks that have really performed well, and they make up the largest part of the S&P 500 and the Dow Jones. Those stocks have done very well. In fact, most of them are not undervalued anymore. But there's a large segment of stocks from small, mid-cap, international, emerging market that are doing quite well now that hadn't done well for about 3 years in a row. And that's a big deal. You know, when I talk about that thing called asset allocation, you know, and they always mess all that up with all the high floating language that they like to use. Basically, spread it out, try to get an accurate representation of all those categories, and then rebalance your portfolio. That's what they're talking about. And I guess that's going to be my role in the remainder of my career, which hopefully lasts as long as Warren Buffett's has. Because I think he's in his upper 80s now, still going strong. But you know, for the first time in the history of the markets, you can accurately represent those categories that they've been telling you to invest in all these years, except that they forgot to tell you that they didn't have accurate representations of those categories for you to invest in. So what people were doing was they were going out and trying to find something that was similar, and then inevitably the returns were not the same as the ones that were being advertised. Everybody got really upset, including me. I'm here to tell you that has changed. It's changed. In the last 5 years, it's actually changed significantly. And there are some things that actually work a whole lot better than they used to. There are a lot of things that don't work anywhere near as well as they used to. And being aware of that I think is going to be very important going forward. Out in the future, it's going to be very important that you're aware of these changes and that you're making adjustments in your portfolios, or your financial advisors are making the adjustments, because it's a big deal. It's a big deal. Anyway, that's going to, the seminar is January 18th. That's Thursday. It's going to start at 6:30. It's at Corporate College East. You can go to my website, bullingtoncapital.com, to sign up for free. There's no cost. If you'd like to call in because you don't have a computer, 330-664-0700, 330-664-0700. And if you don't want to come in, I just did something this week, first time in an extremely long time. I hosted a meeting over the internet. So I have a client, and it's got a computer, and now all the software that I have, you can put up online. It's all encrypted, military-grade encryption. I can pull up your stuff. You can see it, so you don't have to actually come into the office anymore. And I can show you in much greater detail, actually, because here's the funny thing. You know, people actually pay more attention when they're looking at the computer screen than they do when they're in my office. I'm laughing about it, but it's actually a really good thing. And you can see every tool that I have. I can show you my Bloomberg. I can show you the Y charts. I can show you the telechart, all the scans I've run, everything. It's right online. So that's pretty cool. That's an option. We haven't written a lot about that. In fact, this is the first time I'm talking about it because we've been experimenting with it, and it's working much better. And actually, the last meeting went off without a hitch. So beautiful thing. We're going to be talking about all that stuff at the seminar. I'm going to show you what I'm talking about at the seminar. The digital vault, the thing where you can put together important documents. There are a bunch of services out there that sell that service. Okay, that's part of the service that we provide. We are making available as of recently to all of our clients. But not only are we making that available, we're going to show you how to use it. Okay, because when you sign up for Dropbox, which I have, or you sign up for ShareFile, which I have. Or you sign up for the Microsoft version, I forgot what they call it, which I have. Okay. Nobody helps you. You're on your own. Okay. So that's something that we're going to be able to do for our clients going forward. And I think I'm really excited about it. I think it's a great thing. The changes that are going on in financial markets. We're going to have to learn more about that when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because I'll be right back. And we're back. So, I was just talking about, I think I have to take a phone call. And we're going right to the phones. Hey, Jerry, got a question? Is he there? Jerry.
About a specific, good morning, Bill. I have a question about a specific stock. Actually, it's a REIT. It's called Ventus. It, like a number of REITs, has been getting clobbered with the concern of rising interest rates. It's about its annual low. It's paying a juicy 5% dividend. It's got a strong balance sheet. And I'm just curious what you might think of it.
What's the symbol?
VNT, I believe. The stock itself is called Ventus, VENTAS.
Okay, so the symbol is VTR.
VTR, okay, yeah. Thank you.
And it's been dropping like a rock, obviously. It's at $54. Yes. It's really not that bad, though. I mean, everybody thinks that they're going to find that one stock that's not volatile. They're all hoping and praying. And I got news for you. If it's a stock, if it's publicly traded on an exchange, there's going to be a lot of volatility. It's not a little bit. There aren't any stocks that don't fluctuate 40 or 50%. They just don't exist.
No, of course not.
So,
well, as I say, it's been getting hammered with a concern of rising interest rates. And I personally, I don't think that the economy is that strong. The interest rates are going to shoot to the moon tomorrow.
I don't think they can. I mean, you're talking about $11 trillion of interest-bearing debt. Okay,
that's exactly where I'm coming from. Yeah.
Yeah, and every time you raise interest rates by 1%, that means you're adding $110 billion to the federal budget, which they're always arguing over having to pay for anyway.
In an election year, I just don't see it.
Well, you know what? I think at some point in time they might, and some of the better economists out there, in my opinion, actually the ones that have been more accurate over the past 10 to 15 years, are saying that, they think eventually that you'll see a long-term interest rate of around 3%, the Fed funds rate around 3%. Which means mortgages are probably going to be, depending on your credit score, it'll be between 5 and 7%.
Okay.
Which is still, when I was a senior in high school, a mortgage was 21%.
Right, and that's not going to happen overnight either.
No, it'll take.
It's not going to happen. We're talking years rather than months.
Right, exactly, and so I wouldn't be. I don't know. There's so many things that you just can't know the answers to. Let me pull this up under Y charts because that will help me quite a bit. Y charts, for those of you that don't know, I don't get paid by them, by the way. I just really like their service because it saved me a lot of money. You can pull up the financial statements that are filed with the SEC. in Y charts, and the version that I have runs about $3,700 a year. The one that's available to the public, I think it's about $40 a month, and I got to tell you, it's worth it. This is most people, they spend an enormous amount on hobbies and they don't make any money on the hobby. It's just a pure expenditure. With this kind of a hobby, you spend a little bit of money on professional tools and you can make a lot of money.
Well, I was just going to say, Ventus, what they do is it's a REIT, but they invest in nursing homes and assisted livings for, assisted living home.
Well, here, I just pulled up it's
a growth industry with,
well, here's the thing.
With the baby boomers coming on.
Yeah, I pulled up the revenue stream. It was $3.5 billion over the past 12 months. The market cap of the company, that's basically the value of the stock, okay, is $19.5 billion. Okay. It gives you a price to sales ratio of 5.5. That's pretty high, even for a REIT. And REITs normally have a pretty high price to sales ratio because their profit margins are pretty big. But that's high. So I would look at this as nothing more than a normal correction. I mean, this stock was only, it was only $72. It's at $54. That's not a 90% drop. That's well within the realm of normal for just about any company. If you go back and you look at the chart going back to 2013, it's just basically where it was in 2013. So, and healthcare facilities, I don't know. You would have to go and really analyze all the properties that these guys have to do a really good job. And I don't know any real estate trust analysts. And if I did, I'm not sure they would even be honest with me.
Okay. Well, they
like
say it's got properties in 47 states, so it's pretty well diversified across the United States.
Yeah, but you need somebody to verify that. I mean, you really need people that really know the business and know what kind of properties. The dividend yield right now is 5.76. So from that standpoint, it looks pretty good. Now, Jerry, you're the one that likes to do those covered calls.
Right.
This might be a really good stock to do that on.
Okay.
Yep, because it is pretty solid when you look at it. Its price sales ratio is still pretty high. If they've got a lot of leverage, like I said, I'm giving you a 60-second overview. But if I were interested in this stock, this is one of those stocks where you might want to write calls against it.
Okay.
Because you'll get the dividend income.
Downside, yeah.
Now, for the rest of you people listening out there that are confused about what I just said, forget
it. All righty, Bill. I got another question. This is a accounting question or IRS. I don't know if you care to wade into it or if you even know the answer. But as of next year, the tax law changes to you're not able to write off your home equity loans.
Right, but they also increased the
up to $25,000. Yeah. Yes. Well, the question being is, from the IRS perspective, is a personal line of credit and a home equity loan the same thing?
Probably not.
Okay.
Now, I'm just guessing, and quite frankly, we are not allowed. Your certified financial planners, your registered investment advisors, your accredited investment fiduciaries are not allowed. Technically, you're not allowed to give tax advice.
Okay.
You're supposed to be licensed to do that now.
Okay. Very good. Well, it was more or less a question. I didn't know, and I thought I would ask. So,
and when I say not allowed, it's very cloudy on how they're going to rule on that sort of stuff. So, because to be a tax preparer, to give out tax advice, especially when you're on the radio, you don't want to be saying things if you're not absolutely sure. So I'm taking the more conservative route and just saying, hey, look, you really need to talk to a licensed tax professional to get those questions answered.
You're a wise man, Professor Bullington.
No, I don't know about that, but anyway.
Okay, one other question. Sure. The tax law that has gone into effect as of the beginning of this year, do you expect it to provide a significant impetus to the economy to the extent that the Republicans are saying, or how would you go on? Up, down, or pretty much the same?
I think it's probably a little bit too early. It's going to create a larger deficit, which means that you're going to be adding more to the national debt. So at some point in time, that you got to handle that. But I think the economy, we're still not at the debt to GDP ratio that we were at the end of World War II.
Right.
So
that was pretty significant, of course.
Yeah, and the economy did really very well, and interest rates went way up despite the fact that they had all that debt, and they were refinancing that debt relatively quickly. Every year, debt came due, they had to pay off, and they raised the interest rates on that. So, and the government had to pay that interest. So, you know what? I think we are really in a pretty good spot on an economic basis. The only thing that I see is that the large cap stocks have done so well, especially the large cap growth. They've done so well. It is really hard to find a bargain there. Mm-hmm. I mean, it is really hard to find a bargain in that space. They've done so well. And that's where most of the money's going. They're chasing the performance. The other categories are starting to catch up, which is typically how it's gone throughout the entire history of our financial markets. So
now you're talking about stocks in the Russell 500.
No, I'm talking about the stocks that are starting to catch up. Are small cap, mid cap. Yep, international,
okay.
Emerging market. Those are doing quite well, and you might want to pay attention to that. Now, here's another thing that's really, really changed, and this has been going on over the past 10 years. One of the reasons I left to start my own firm was I saw and if you go back and listen to my old radio shows, I still have them, by the way. I was talking about the development of exchange-traded funds. Back then, there were about a dozen of them. Okay.
That was a few years ago.
Yeah.
Obviously.
Well, now there are a couple thousand, and it's the fastest-growing segment of the financial services industry, and it's changed. It has fundamentally changed the way the market operates. It's changed, and it's not going back. And I know a lot of people are upset that I didn't see this coming and tell me exactly what to do. Well, good luck with that.
Yeah. Well, what's the difference between the Russell and the low mid cap? I thought they were essentially the same.
No, Russell is a company that does research and does index construction and advises big pension plans. They've got they've got a couple thousand indexes.
Okay.
And so you got to know which index that you're looking at. The most popular one's probably the Russell 1000. It's the top 1,000 companies by market cap. That's by size. Okay, so by size, the top 1,000, because the S&P 500 are the top 500 by size.
Right.
Okay, publicly traded, by the way, and typically domiciled in the United States, or at least listed on our exchanges.
I was going to say, now, you said if you were looking to invest, you consider the low to mid caps and perhaps some of the
international emerging market.
I was going to say European.
By the way,
Asian or what?
Those are
Either
excellent.
Or.
Yeah, no, get them all. It's so cheap to do that.
Either or. Yeah. Asian as well as.
Get them all. Don't try to pick the winner.
Okay.
Don't do that. You're going to hurt yourself. You're going to be really upset. I've seen so many people do that. And when it doesn't work out exactly like they wanted it to right away, they get upset and they change, and then they miss the move. So don't do that. You want to own all of them. If they're underpriced, you want to own them. You want to cut back on the ones that are overpriced. I don't have a whole lot of large cap. I don't have a whole lot of large cap growth in my portfolios right now. Why? It's not fundamentally undervalued.
Okay.
So I don't want to be buying something that's overpriced. Especially if I plan on hanging on to it for a long time, because that means I'm going to have to go through that down cycle and then wait for it to come back up and then hopefully make a decent profit. That could take 10 years.
I would assume you would include stocks like GM and Cisco and in that group.
Those two stocks are probably have some of the better valuations. The other ones, like you look at Apple, it's a little high now.
The FANG, yeah.
FANG. Amazon. Google, they're not underpriced. They're not grossly overpriced like they were in the late 90s.
90s, yeah.
Right. But they're a little overpriced. And if all other things being equal, I'd rather buy good companies that are underpriced than buy good companies that are overpriced.
Oh, of course.
In the long run, it's going to make a difference. When it's going to make a difference, I have no idea. Nobody does. So.
Okay. Thank you, William. Have a nice day.
Thanks for calling. All right.
Bye-bye.
Bye. I got Phil. Phil, hey.
Hey.
How you doing?
Good. Hey, Bill, a few weeks ago you had mentioned a mortgage-backed bond fund, I think.
Yeah.
with 3 or 5 year left on it or so.
Average maturity. Yep. Yeah.
Yeah, I couldn't figure out who it is.
Well, there's a couple of them. And by the way, I've been talking to my compliance people who are actually reading some of the stuff that's been written. We're not allowed to mention individual names on the radio.
Oh, no kidding.
Yeah. Well, it's not a good idea. So
all right, I'm not going to push you then. I did send you a couple of emails, but no answer.
I know. It's been this is the beginning of the year, and man, you don't want to see my schedule.
No.
But I will send it out to you. In fact, I'll probably send a little email out to everybody. Everybody's kind of they're looking at what to do with fixed income, and I got to tell you, it's not exciting because the yields on them, you're looking at right around 3% or so. That's not exciting.
Mm-hmm.
The fact that it's a government-backed security, that's exciting because you got the full faith and credit of the United States government behind those things. And they are seasoned mortgages. So when somebody gets to within 5 years of paying their house off, they generally don't default.
Right. Mm-hmm.
So from that standpoint, from a credit standpoint, they tend to be safer than buying a mortgage-backed bond fund whose average maturity is 30 years. So
right.
All these little things have said, and because most of the money coming back into the fund, a big percentage of it is principal. If you remember back to how mortgages actually operate, when the mortgage is up front in the first 5 years or so, you're paying almost all interest on the mortgage. And then near the end, you're paying almost all principal. So every month, a big chunk of principal is coming back to be reinvested. Now, it'll give you, from a fundamental standpoint, that's what you want. I want money coming back in so I can reinvest while they are raising interest rates, which has been the trend over the past couple of years. They haven't been raising them fast. They haven't raised them far. In the meantime, the prices on those bonds it's going to fluctuate. It's not going to reflect the actual net asset value. It's going to reflect the price. There's a difference. A lot of people think that they're always reflective of exactly what they're worth. That's wrong. That doesn't work that way. They're worth what people think the price is based on what they think they're worth, not what the actual underlying value is. There's a difference. They call it a premium and a discount. Sometimes the bonds will sell at a premium. People are paying more than they're actually worth. Sometimes they're selling at a discount where they're paying less than they're actually worth. And the average investor goes, well, why would they do that? Well, because it's the way financial markets work. I can't really tell you. I'd have to take a poll of the millions of people that are investing and find out.
Yeah.
Why are you doing that? And it's based on perception. If the perception is that it's not going to be good, then the prices will go down. And oftentimes they'll go down lower than the net asset value of the underlying instruments. That's one of the challenging things of investing in funds. The actual value can be higher than the share price, and that is really hard for a lot of people to get. I can tell you, a lot of people never get that, and they think stocks are the same way. Well, that's exactly what it's worth. No, that's exactly what people think it's worth today. Tomorrow, that may change.
Gotcha. I understand.
So, but I like those types of bonds for right now because you're not going to get. You shouldn't have extreme volatility in them. They're going to have volatility because they trade on a stock exchange, and people are always buying and selling.
Also, by the way, your dividend model had a very nice year also, I must say.
Oh, thanks. Yeah, and most of them will. In fact, by the way, the only model that I have that hasn't been knocked off now is the momentum model. Every other model I built there's at least 2 other versions of it in a fund. And I'm just going, wow. That blows my mind.
It's a compliment to your mobility.
I just couldn't wait for them, though. Theirs are newer than mine are. They came out a little later, but they're there now. And so it does make it a little bit easier because it's easier to invest in a fund than it is to invest in a whole basket of stocks like that. And the paperwork is so much less. I mean, there's just, it cuts the paperwork down. But so I'll probably only be sticking with the momentum model through Folio because everything else has been duplicated, and I've actually incorporated that into the ETF model that I'm running now that has the international emerging market, small cap, mid cap. It's got the dividend paying stocks. I tried to build it so that it would overweight large dividend paying stocks in the United States because I think that's where the value is right now, and they tend to bounce back faster from a decline. You look at that portfolio, how it did in February, March of 2016 when the market dropped like a rock right in the first, in January. And look how fast that came back. And all those funds like that, the ones that pay dividends and concentrate on the dividend yield, they all came ripping back. They had one of the best quarters they'd ever had. And so that's important. And to know why that works that way, it's pretty simple. But knowing why is a big help to you when you're investing. Investing is 95% psychological. When the share price drops, the dividend yield goes up. So when you're reinvesting the dividends, you're buying more shares at lower prices with higher yields. Right. You're winning on all three fronts there. When it recovers, the things that tend to go back the fastest are those dividend-paying stocks that have been beat down the most. Right.
I remember you sent something in the mail before I got in, showing some of those months. They had some incredible months on the bounce back.
Yeah, I know that's one of the reasons it's important to have a plan, a basic plan, something as basic as that. Let's buy big companies that pay dividends, and let's do it in an organized fashion. You either do it with a fund or you put a basket of stocks together that you put some thought into, and then you stick to it. And when it's time to change, you won't even know when it's time to change. I'll tell you when it's time to change. When the S&P gets back to 30 times average earnings or over, you're not going to want to be in the S&P anymore.
Yeah, I would say.
Every time that's happened, it's been negative 10 years later.
Yeah.
So when that happened, we're not even remotely close to there now, by the way. But if that were to ever happen, you'd hear me talking about that quite frequently on every show.
Super. Tip off there.
Yeah.
Good.
Yeah.
So are you going to keep the dividend model the way it is then, Bill? Am I getting that? Or
I'm putting it up to whatever investors want to do. If they want to keep it, that's fine, because I really love the model. It's been in its class, in its category. It's in the top 25%, which is awesome. They've got the option to do that. You can take any of the other models I'm running. I like the momentum model. That's just one of my favorite, and it hasn't been knocked off yet. There are a lot of momentum models out there, by the way, now. They've really, that category has come on really strong in the last 4 or 5 years, actually the last 3 years. So, but nobody is able to equally weight their portfolios. They're all market cap weighted, and that does give me a little bit of an edge in that category.
Sure.
And the chances of them doing something like that are extremely remote, because when you're managing billions of dollars, you can't equally weight a 40 stock portfolio. That's just impossible. You'll end up pushing the prices of the companies that you're buying up past the point that you want to be selling.
Right.
So they're kind of stuck there. But
okay.
Hey, how was your holidays?
Good. We had a nice weather. We did some driving to Xenia and back, and everybody's healthy, so that's good.
Yeah. Oh, that's a blessing. So
that's it. That's all you can ask for at my age.
Yep, I hear you.
So anyhow, I'll be waiting and watching and listening and going to seminars. That's all I can
do. Sounds good. Well, hey, thanks for calling.
Bill.
Have a good weekend.
You too. Thanks, Bill.
Yeah. Bye-bye. So, you know what I forgot to talk about? We got about 15 minutes or about 10 minutes left, I think. At the seminar, we're going to be talking about the service that where we help you track all of your investments. We're providing a service through Bullington Capital that allows you to sign up all your accounts. You can add them. The technology, I've tried to use this like 4 or 5 times. We went last year, so I think it was around April, May, or actually just this past year. Yeah, around April, May. So I've been with it about 9 months. Been working really hard with it. The company is owned by Fidelity that owns this company. When you go to the website, it says Bullington Capital on it. They have you private label it. But it is a huge organization standing behind it. The security is top notch. It's a read-only site, which means that they can't hack your accounts and make transactions by trying to copy your password or user ID. So we're really cognizant and careful of who we do business with that way. And we take every step that we can. We do the very best we can. And I think it's a really useful tool. It's got so you can see everything in one place. You can put all your important documents in there. You can put your important contacts, kids' information. It's really a good tool. And we're going to be spending just a few minutes taking a look at that at the seminar. And we're going to spend a lot of time talking about what we've been talking about in the past few weeks, how markets have changed fundamentally. I'll give you an example. Target Corporation, Target, the big retail chain, goes up 3.78% on Friday. It's actually up quite a bit from its low, which was reached back in June. It's up about 58% since June. Now, let me say that again. Target, the big company, it's huge. Target, in fact, let's go to Y charts. I'm going to pull this in and find out what the market cap on Target is, because I know it's gigantic. Yeah. Target has a market value of $41 billion. Okay. Almost 42. $41 billion. You know, a billion is 1,000 million. That's what a billion is. A billion is 1,000 million. And they got $41,000 million. That's $41 billion. And it moved, it went up. Now, if you took that back to where it was a few months ago, that was a lot lower than that. It was right around 30 billion or less than 30 billion. So less than 30 billion. So it's changed in value like $12 billion, 12 billion with a B in the last 6 months. And it went up 3%. That's like 1.2 billion. So $1,200 million in a day. This is what I'm talking about. This stuff did not happen earlier in my career. This didn't happen 5 or 10 years ago. Okay. It's happening. It's happening a lot. There are things you can do to try to take advantage of it. There are things that you can do. Now, it also presents some risk because 6 months prior to Target being at that low price, it was at the same price it is today. So if you bought and held it, you're going, whoo, I got my money back. But you had a big scare. Now, if you were lucky and you bought some in June near the bottom, you're going, all right, I'm up over 50%. So, and by the way, there are only two types of people that buy that in June at its bottom and are holding on to it today. They're the lucky and the liars. People that got lucky because it was only there for about 15 or 20 seconds. And anybody that tells you that, I don't know. Maybe they got lucky. I'm going to give them the benefit of the doubt. You got lucky. I won't even ask you to show me your statements anymore. Because anyway, that's what can happen, and that's a big change. That's a big change to be going from, making a couple $100 million moves, over a few months to making moves worth of billions of dollars in these huge companies. That's a change. Okay, and there are things you can do about it. Now, there are a bunch of things that you can do about it. We're going to talk about some very specific items at that workshop. And I don't know if I remember, or if you remember, if you're listening, that I told you, I'm going to raffle off a couple of my Cavs tickets, a game I can't go to. Cavs have been on a losing streak lately, but that's because those guys are old, man. They're tired. They'll pick it back up. I have no doubt. I'll pick it back up and start running. But anyway, I think it's going to be a really good seminar to get to. I think you'll pick up some things that you can take with you. I will make a copy of any material that I use and make that available after the seminar. So, feel free to go to my website, bill@bullingtoncapital.com. I'm sorry, that's my email address. Go to my website, and it's bullingtoncapital.com if you want to sign up for that. Because I think this is, we're standing at the beginning, or actually it's probably midway through one of the bigger bull markets in the history of the country. Does that mean you won't have a bear market in the next few years? No, it doesn't mean that. Well, I would never say that. Because I can't predict the future accurately. And those people that think they can inevitably find out that that's really hard to do. So things right now are pretty good. When I'm looking at the stocks coming up on scans, Like, this is one of the things that you can do about it. You can open up a small account if you like doing this kind of thing. Target came up on that scan. If I were to buy Target at $76, I'd put a 10% stop on it and a 15% trailing stop. And I'll just let it go. Why? Because in the last 6 months, Target's outperformed 90% of other stocks. And by the way, it went up 3% on Friday. Okay, a stock that goes, a $40 billion company that goes up 3% in a day, I would call that significant. That's pretty significant. Okay, doesn't mean it's going to keep going up. Nope, it doesn't. But if it goes down 10% from your purchase price and you get back out again and start waiting, put the money back on the sidelines. Timing wasn't good. It's like Target, when they buy products to sell in their store, they try to do as much research as they can. We think we can sell this. We think it'll go for this price. A lot of those products end up on the discount shelves. And mark the price down and try to move them out. Oh, we're sorry, we were wrong. It's the same thing. It's the same thing. That's exactly what you're doing with your stock investments. It's not gambling. It's called business. This time you're a retailer of stocks in your portfolio. When you run a small portfolio for yourself, you actually have a small business. That's what you're doing. You're running a business, and it's a lot like retail business. It's also a lot like the actual process of selecting stocks and using this particular investment management style is a lot like a designated hitter on a baseball team. If you hit 1 out of 3, you're going to get paid millions of dollars. If you can hit 1 out of 3, you'll go down in the Hall of Fame one day. And guess what? It's also really streaky. Sometimes you'll swing and swing and swing. You won't get a hit. Sometimes 20 times in a row, you don't get a hit. But then if you've been playing if you've made it to the major leagues and you're a designated hitter, you just have to keep swinging. And eventually you get your stride back. And it works very similarly. It is eerily similar to that. Now, the reason I'm talking about this is I put courses out on this over time. I think it's incredibly appropriate for today. I think that today that the opportunities that this affords are pretty good. It's not what people want it to be. People want to be right 80 or 90% of the time, and that's a problem. You tell a baseball player, hey, you've got to bet 800 or 900. You know how many people are playing next year in the major league? None. Nobody's 800 or 900. If you came out and said that's what you got to do to keep your job, well, you'd end up firing everybody. Okay. So you come out and say, hey, do the best you can, and we're hoping you get the base safely 3 out of 10 times. Yeah, that would be good. Yeah, or you get a hit 3 out of 10 times. That would be great. If you came in with that same attitude, you could do very well in financial markets. If you can't get yourself to do that, and I understand. If you can't get yourself to do that, then you shouldn't. You shouldn't even try. You should just do the traditional, get the broadly diversified portfolio, bonds and cash, or bond stocks and cash, and relax. Try to enjoy life. Anyway, I hear the music. That means the show's over. Thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representation